Alright, good day everyone. This is Mapletree Industrial Trust, second quarter and first half FY 25-26 financial results dated 29 October 2025. Right, we go through the key highlights for second quarter FY 25-26. Right, the first three numbers here will look bad, right? 7.8%, down 7.8% year on year, down 5.3% year on year, and down 5.6% year on year, right, for NPI, distribution, and DPU. Right, but this is sort of expected because last year, right, last financial year, they were distributing the divestment gains from their portfolio out as dividends, right? But this financial year onwards, they stop. Instead, whatever they divest, they choose to use the money to pay down debt, right? Later on, we'll talk more about this one. So the first three numbers being down is sort of expected, right? However, even if you exclude the divestment gain excuse, right, you can see DPU is actually down 2.2%, right? So this is a number that we should be concerned about, right? Despite the fact that there's no divestment gain from last year, right? Last year still performed better than this year. Okay, we look at portfolio update for weighted average rental revision rate, right? It's actually 6.2% this quarter, and this looks okay until you compare with the last three quarters lah. Third quarter 24-25, it was up 9.8%. Fourth quarter up 8.1%. First quarter this financial year, which was the quarter before this, it was up 8.2%. Right, so it looked good until this result lah, which is up 6.2%. Right, this is not a good thing lah. Right, so with this dropping rental revision rate, it looks like demand is softening somewhere within the REIT. Right. The rest I won't talk too much about this. This is a new line, right? Executed 2.6% of North American portfolios NLA. I'm not quite sure what they are trying to say here. I think it's big. They are just renewing, or they actually managed to lease out 2.6% of their North American portfolio, right? That's my take, right? Not very sure about this, honestly, right? So they divested the 3 Singapore properties, right, on 15 August 2025. Yeah, so. And this money was used to drop their leverage ratio down to 37.3%, which is about the only positive thing about this report, in my opinion. Right, the rest I won't talk too much about. All right, second quarter versus second quarter last year, I won't talk too much about. The numbers are, we'll just go straight to MPI. Right, it dropped 7.8% because of divestment of 3 industrial properties. Right, this is the main reason. Right, but this is the worrying part. North American portfolio non-renewal of leases. That means the North American portfolio, people are not renewing their leases there lah. That means the vacancy is probably getting worse, right? Or maybe some non-renewals were compensated for the above point where they said they did manage to rent out some of their North American portfolio. Okay, either way, right? To me, this is not a good sign lah, right? And of course, partially mitigated by Japan portfolio. Borrowing costs dropped as per what we said earlier. Some of the borrowings have been paid off using divestment, right? And some of the things that are normal lah, because unhedged floating rates have gone down with the US dropping interest rate, and of course weaker USD against SGD recently, right? And partially offset by the fact that borrowing is slightly higher due to Japan portfolio, but overall borrowing cost still has gone down. Okay, so these are mitigating factors, right? We only want to look at this one lah. It's dropped by 2.2% as we discussed earlier. Not going to talk too much about first half against first half also. I'll just focus on this, right? Second quarter versus first quarter FY 25-26, right? Because I think for MIT is unlike, for example, retail REITs where there's seasonality lah. So you have to compare second quarter against second quarter, or banks also like you compare second quarter against second quarter. I think MIT don't really have this type of seasonality problem. So I want to look at its latest result, which is first quarter FY 25-26. Gross revenue has dropped. Is partly because of actually is definitely because of the divestment of the 3 industrial properties in SG as well, right? But the thing that I'm a bit shocked by is the property operating expense. Why has it gone up by 9.2% when you have divested 3 properties? Yeah, so this is something that I'm very concerned about. Somehow they don't have their operating expenses in check, right? That's my opinion, right? So this is a very big scary number, right? Which is why the net property income has dropped by quite a bit, in my opinion, right? So clearly divestment of the 3 industrial properties has an impact, right? A full quarter impact of lease amortization for the fit out works at one of the properties in SG Singapore. I think this one is some cost associated with works in SG property in Singapore lah. Hopefully this is a one-off, right? Higher property and maintenance costs and utility expense in both North America and SG, right? So this is the point where I'm really concerned about, because I suspect this will be a recurring problem, right? Of course, partially offset by the Osaka data center addition. Right, bond cost drop, we talk about this, is because of divestment of 3 properties. Won't talk too much about this anymore. But if we look at last quarter against this quarter, you will observe that this financial year, there's no more divestment gains, right? Because it's been used to pay off debt lah. So we can just look at the DPU as it is, right? And it's actually a drop of 2.8%, right? Which is, to me, disappointing lah, right? Because I didn't expect the DPU to drop again this quarter. Alright, to be honest, I thought at least should be able to maintain, but yeah, it dropped. So this honestly, the results are disappointing to me. Right, I pulled out this slide. The last time this slide was featured was fourth quarter 24-25. So I want to make it clear that this slide is not in this presentation. I added this slide in. Right, it's been missing since first quarter 25-26, and I think the main reason is because they probably knew from this quarter onwards that DPU is going to slide. Right, so you can see very nice clean upward trend of DPU, right? The most recent trend looks like it's stabilized, right? A bit up, a bit down, but look like stabilized. But quarter 1 and quarter 2 has shown that it's sliding, right? So first quarter is 3.27 cents, and second quarter is 3.18 cents. So you can see the trend is sort of sliding down. And I think third quarter we may have to expect further slide of dividends, right? Unfortunately lah, if you look at the tone of management, right? So here we have to see what is MIT's management really made of lah, because if you look at MIT's history, it's been very nice upward trend from FY 10 and 11 until here, right? So all the way until here is increase in DPU, right? Then you hit a high interest rate environment here, right? And it was negative for 2 years, right? So 2 years of negative after the total positive trend in DPU growth, right? Then finally, last FY actually was positive again, but I think this FY is clearly a negative already lah, right? I find it hard to think that we'll end the FY with a positive trend in DPU this time around, right? Financial result, financial statement, nothing much to say lah. In line with what is going on earlier, except that NAV has dropped to $1.69, right? And this is a concern to me because MIT has traditionally traded above NAV, right? So at current price, I think it's around $2.05 roughly lah, right? So it's still significantly trading above NAV lah. If the DPU keep trending down, I suspect this premium to NAV will disappear, which means that I think the stock price will not perform very well in the near future, right? Not financial advice, just my thinking right now, right? So the only good thing about the balance sheet is the aggregate leverage has dropped, right? My sensing is that they will use this space in their leverage ratio to acquire more properties, as you will see later on, right? Interest coverage ratio is still very strong at 3.9 times, right? So supposedly we don't really have too big of worries, right? But this is the point where we have to be very concerned about lah. They say that $600 million of interest rate hedges are expiring at the end of FY 25-26, which is this financial year and the next one. So higher borrowing costs from the replacement hedges may continue to exert pressure on distributions. So I think this means that we should expect DPU will carry on dropping, right? If we consider that the US data side is still, data centers are still struggling, right? Yeah, so this is the part of the debt that we have concerns with. We talked about this earlier, so I won't repeat too much about this. I won't talk about this. Yeah, North America side is the main problem, and unfortunately it's quite a significant part of the portfolio lah. So that's quite worrying. You can see the occupancy for data centers is below 90% already. Okay, and I believe that they didn't break down by country lah. So this is overall North American portfolio. Yeah, so yeah, you can see by country is here, North American portfolio here. North America is purely data centers. So this is data center occupancy. You can see it's even worse than the average lah. It's 87.8%. Right. So this is a point of concern. Japan is the only new site doing well lah. Okay. Not going to talk too much. This is a slight positive lah. You can see general industrial buildings quite a lot to be renewed. This is the best rental revision I think in their portfolio, right, as you will see later on. Yeah, so they say here that they are going to try to, okay, I'm not going to read everything here. I'm just going to say they are trying to mitigate the vacancies in North America data centers. And as you can see, it's quite a big part of the portfolio, right? Having a slide like that is not good. It's like telling you that the North American portfolio clearly got problem, right? There's a low demand problem there. And whether or not they can compete with the supply coming up, later I'll talk about that, is a big issue, right? So they are hoping to leverage on this part because this Singapore and Japan still has higher demand to protect the North American side. But generally speaking, you look at a slide like that, it's not good news, all right? Not going to talk about this or this. Yeah, you can see rental revisions for high-tech buildings and business space is minus 1.6%, right? It has gone negative lah. So this is part of the reason why the rental revisions as a whole has been dropping from 8.2%, which was first quarter, to 6.2%, right? So there's a weakness in this space all right. General industrial building is still okay at 8%, right? Which is why I say that just now that number is a slight positive, right? So this is, yeah, general industrial buildings, as you can see here, right? But I still expect DPU to go down. Let me see. Yes, yeah, we talked about this. This is just the divestments that they have done. Not going to talk too much about it. Outlook, yeah, okay. Yeah, we talked about the borrowing costs are anticipated to increase earlier already lah. So this is a concern, right? So with the revenue dropping and cost of debt going up, that's going to squeeze DPU lah. And this is the part that is quite stuck. They say they will undertake strategic divestments in North America and Singapore to enhance financial flexibility, right? Which means I can buy something else and deploy capital into markets and assets that can provide sustainable growth. Basically, they are repositioning. And to me, this is not good news because clearly North America got a demand issue, right? So that means the supply is too much. And now they are trying to sell their North American data centers, which are old and clearly got no demand. So how much can they sell it for? Can they sell it for above the pricing? I won't be surprised if in the near future they start selling at below the valuation. Or the other way to look at it is they can just, the valuation can just drop and they sell at valuation or slightly above valuation, but that's after the valuation drops, right? So this is a very, very big concern for the REIT right now, right? So you can see this is one of the main issues, right? The inventory is at 8,155 megawatts in first half 2025, right? Representing a 43% year-on-year increase. And what is under construction is 5,243 megawatts, right? And 74% has been pre-leased. That means the demand is filled, right? This is a 64% more supply over this, which is already a 43% year-on-year increase. So the supply side of data center inventory in America is insane. And of course, you can say it's partly due to the AI demand and so on and so forth. But if things were to go south somehow, right? I'm not saying it will, but this is another hidden risk in MIT right now, that they are so heavily involved in the North American data center markets that if the data center market there explodes because of overwhelming supply, right, and not enough demand, I think they are going to be hurt quite badly. And this hasn't even come into play yet, and they already have issues, right? So that's my concern, major concern with MIT, right? I think that ends my presentation for today. No investment advice is given here, right? Thank you for listening.